Let's start with a simple truth about the world of banking. Every major lender, from the biggest banks down to your local credit union, lives and breathes risk management. Whether it's a mortgage, a personal loan, a credit card, or that versatile tool known as a home equity line of credit or HELOC, their entire model depends on knowing, almost before you do, if you're at risk of missing a payment. But how do they pull off that feat of financial foresight? The answer is a process called the credit pull. By regulation, every 3 to 6 months, financial institutions must poll the credit standing of their existing loan clients. Practically, this means they're regularly checking your credit file to see whether you're staying on top of all your debts, not just those they've issued themselves. Have you missed a car payment? Are you running up balances on your credit cards? Have you taken out a new loan somewhere else? All of this is tracked, collated, and fed into sophisticated risk models that banks use to protect themselves. Now, you might think that once your HELOC is approved, the bank's done with its homework, but the reality couldn't be more different. HELOCs are demand loans. That means at any moment the bank reserves the right to call in the debt or freeze the line of credit entirely. Why? Because what makes a HELOC so flexible for you, letting you borrow against your home equity as needed, makes it fundamentally risky for the bank. Picture this. You wake up one morning to check your bank account. Maybe you're carrying a $200,000 HELOC of which you've drawn $30,000, paying a hefty 10% in annual interest. That's $3,000 a year just in interest, or $250 a month. Money you've baked into your budget, expecting it'll be there as you pay down the loan, maybe slowly, maybe simply maintaining the balance for years. But then the credit pull comes. The bank sees that you've recently taken on a couple more debts. Maybe you missed a single credit card payment. Maybe they notice the value of your house has dropped 30% as per recent appraisals or market data. In response, the bank could invoke a little discussed but entirely legal clause, the right to demand repayment of demand loans. They give you a year to clear the slate, which means your $30,000 loan now requires you to make payments of $2,625 a month, more than 10 times your previous minimum. If you can't pay, the bank may move to foreclose on your home. This is how individual risk translates quickly into systemic risk. To avoid damaging your credit rating, you're forced to put your property on the market, joining a growing crowd of others in the same position. You lower your asking price, hoping to stand out among hundreds of similar listings, potentially dropping the price another 20% just to attract buyers. Your nightmare doesn't end there. After real estate fees and taxes, you discover the sale won't even cover the outstanding debt. Now you might have to liquidate other assets, investments, a second car, maybe even a family cottage, just to pay back what you owe. Multiply this cycle across thousands of households and suddenly, what once seemed like a personal problem becomes a market-wide crisis. Nowhere was this cascading effect seen more starkly than in Toronto during what came to be known as the Toronto condo apocalypse. Contrary to popular belief, this wasn't the result of a single shock, like a natural disaster or a sudden global recession. Instead, it was a gradual but relentless pileup of negative trends. First, interest rates had been creeping upward for months, squeezing borrowers' budgets. Next, the Trump 2.0 tariff wars hit Ontario manufacturing and exports, shaking the province's economy. All the while, developers had flooded the market with new condo projects, many priced 30% higher than the average resale unit, fueled in part by speculative demand and artificially boosted by easy foreign money. But the real clincher was political. The previous government had promised international investors and businesses a growing GDP, largely by approving over 2 million visas for foreign students and temporary workers. These newcomers filled rental units, bought condos, and propped up demand until the sudden policy shift. When the visa programs were abruptly canceled, the flow of international money dried up overnight. Combined with a glut of new, overpriced condos and a cooling economy, the market simply couldn't sustain itself. As a result, forced sellers rushed to offload properties, pushing prices down in a spiral. Investors and ordinary homeowners alike were left underwater, their mortgages exceeding the value of their homes, often with little hope of recovery. And those credit pulls? They kept coming, only accelerating the exodus. In the end, the Toronto condo apocalypse served as a warning. Real estate collapses are rarely driven by one dramatic event. More often, it's a slow-motion convergence of policy changes, economic headwinds, interest rate shocks, and the unyielding mechanisms of financial risk management, like the credit pull, that turn everyday realities into full-blown crises.